Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
All right. Cameron, nice to meet you.
Nice to meet you as well. Happy to be here.
Yeah, I'm stoked about this, and I'm glad you actually responded to my my LinkedIn message. I mean, you're busy, you're out there, you're talking markets all the time, and I'm honored you came on the show.
Well, honored to be here. It's super cool and happy that it made it through the deluge of LinkedIn messages. So happy to be here.
Absolutely. Thank you for tuning in to Trends with Benefits. My guest today is Cameron Dawson, Chief Investment Officer at New Edge Wealth. We're going to be talking about what's next in markets for the rest of 2024 and beyond. And you know, we are speaking now, and I think it's August 9th that we're recording this. Monday, on August 5th, we had a pretty big sell-off in the markets globally. And, you know, typically I don't really like to date the episodes because this will come out, you know, maybe a couple of weeks later. But I wonder if there are any long-term impacts from what we saw in market fluctuations this week. It seems like at least the U.S. markets are kind of back to where they started at the beginning of the week. But has anything changed in terms of the outlooks for other asset classes or other segments of the U.S. markets? Was that a time to buy and perhaps reposition?
It's such an interesting question because it raises the point of the phantom third mandate of the Fed. So we know that the Fed has its two stated mandates of price stability and full employment, but we've seen the Fed act in response to financial instability at different times in the past. Of course, the Fed acted in 2023 with the meltdown in the regional banks, and they acted not because there was some concern that maybe it would bleed into economic weakness, but a lot of it was in response to financial market instability. The same thing if you go back to 1998 with the meltdown of long-term capital management. They responded to financial market instability. You could even argue in 1995 that part of the reason why they cut rates is because you had seen things like the Orange County bankruptcy back at the end of 1994, and there was some softening in economic growth, and so you kind of had a little bit of a mix of financial market instability, a little bit of softening and growth gives you the green light to be able to cut rates. And so to your point is there a long-lasting consequence to what we saw over the course of the beginning of August? And the answer is it depends if it continues. If this was just a one and done and we saw this really sharp rebound in positioning, the unwind of the yen carry trade, yes, Japan melted down by 12% in a day, its worst day since 1987. It since has bounced back. If that's the extent of it, then it shouldn't really be an impact or a impetus for the Fed to accelerate rate cuts. If that's the case, then the pricing of all these rate cuts that is currently priced into markets today, which is 4.5 cuts by the end of the year, effectively saying we get at least 150 basis point cut, then that likely has to get priced out. But if the volatility continues, then you could argue that gives the Fed the air cover to be able to prioritize financial market and stability. And even if you don't see a distinct weakening in the labor market or this super sharp slowing in inflation, that they could act. I would kind of throw in one historical precedent as what typically happens after big market meltdowns or flash crashes is that typically, they do take some time to resolve themselves. So, I mentioned Japan had the worst day since 1987 back at the beginning of August on August 5th. What you saw when you go back to 1987 is you had your initial flash crash on Black Monday. You saw the market rebound, and it actually took 2 months of highly volatile trading until the beginning of January to make an ultimate low. It's one anecdote, one story, doesn't have to happen that way, but it's a good reminder that sometimes when markets are dented and bruised in a really significant way, it can take a little bit of time to heal, just like the rest of us.
Yeah, that's true. Do you attribute the volatility this week to the pullback in the yen carry trade or more so to the U.S. economic reports?
Yeah, technical analysis has this term called the confluence of evidence. And I think that there's also an aspect of it's also the confluence of impacts that I think is what caused such a degree of volatility. If we walk it back to the beginning of July, or really mid-July, what we saw is that positioning across the board, no matter where you look, got very stretched. You saw equity positioning get into between the 96th and the 99th percentile, depending where you look. You saw huge flows into equities. You saw the VIX continue to stay in this sub 13 range, really low. Put call ratio was low. There were signs of complacency, stretched valuations. And so you were primed that everybody had quite literally moved to the same side of the boat. So what happens when that is you lose an incremental buyer or seller, depending if it's long or short trade. And that then comes to the head at the same time is that you had overbought conditions and a lot of key indices. So it creates this proverbial toxic brew that it doesn't take a lot of surprise or change in the opposite direction to spark massive unwinds. So when the Bank of Japan comes out and sounds more hawkish than expected and data supports in the US that the Fed could be more dovish than expected, then all of these one-sided trades have to get repriced. Then you added on top of that toxic brew fears about growth, which we could discuss if they are founded or unfounded, and that's everything kind of builds on itself. So our view has been that that it's positioning and sentiment that has magnified the moves far greater than the fundamentals would suggest. And that suggests that you could see a sharp snapback. It doesn't mean, though, that we should ignore the fundamentals, because we do see some important things happening and trends with fundamentals that we think could start to change that underlying fundamental story.
Hearing you speak just reminds me of how interconnected markets are and some of the different indicators that you look at, too. I don't know if regular individual investors necessarily keep some of that in mind. And I'm thinking about one of your more recent articles on small cap stocks. What did you call it? It was something, an ode to maybe.
I'm a really big Third Eye Blind fan. So that was, and I had just seen them perform. So the whole time I was watching the show the day before writing it, I was thinking, what can I use? What can I use? And that's where that came from.
And I think it's awesome. I was looking at some of your articles. It seems like you start out every one with a music reference or a song reference.
Yeah, definitely. So it's always the earworms, and then they spark some kind of idea, and it makes it really fun. And sometimes it's things that people know. Other times it's really deep tracks. So people get to live in my brain world of like being a secret big metal and emo fan. I will admit.
Oh man, you just said metal. I like metal. Anyway, so we'll come back to that. I like everything actually, but in that article, you're talking about small cap stocks and how much they've lagged, and there's something that stood out to me, which was the positioning. Maybe it was like the short positioning and the futures markets was kind of maybe it was like super short, and so maybe there was that gunpowder for a bounce back, and I hadn't thought about that in terms of different areas of the markets to look at when you're considering just say small cap stocks. And are you seems like you're looking at all these different things. You got to keep everything in mind.
Yeah, it's so very important, because what we find is that you can get the fundamentals exactly right, but if you don't know where positioning is or what people are already expecting, then you're likely to get the stocks wrong, which just means that you could be absolutely certain that estimates need to get cut for small caps, for example. However, if everybody already expects estimates to get cut for small caps and they're already positioned for estimates to get cut for small caps, then you are set up for a very strong mean reversion trade, because again, it's back to that everybody on the same side of the boat. So what we do is we pair the fundamental analysis of the trajectory of things like earnings, but then we'll pair it with what we affectionately call the mood rings, which is positioning, sentiment, and overall valuations. And that can give you a really good sense of how much of whatever our fundamental view is shared by other people. And if you get to the point where it's shared by everybody, then there's a chance that there could be trouble where you see things move in the opposite direction of what you expect, because everybody's already there. It's classic short covering kind of rallies. And the big question then is, do you buy it and chase it, or do you fade it? And that's where the fundamentals come back in, because a short covering rally can be ephemeral. Look at what happened to small caps in November and December of 2023. Massive short covering rally, huge flows into the ETFs, people coming out and saying small caps are going to rally 50% in 2024. Lo and behold, instead of rallying 50%, they lagged significantly for the first half of the year because their earnings estimates were cut by 25% in that time. So that's where you have to marry these different sources of information to create, again, that confluence of evidence.
Yeah, and I assume that's how you help set expectations for investors, especially when given something like the S&P and the Mag 7 and the expectations for future returns and probabilities of future returns, just the confluence of evidence to put that in perspective.
Yeah, the hardest part with those things like valuation, sentiment, and positioning is that they're really bad timing tools. So you could identify that things are extreme in those measures, but they can get more extreme. And we went in December of last year, we wrote a tool-themed piece called Invincible, and looking at sentiment, positioning, and valuations, and said they are stretched, but they're not extreme, which suggests that they have room to get more stretched so more people can get drawn into this market. As we got into June and early July, we started looking around and go, okay, now we're officially extreme. But at that same time, it doesn't ring a bell at the top to say, okay, now's the unwind. You typically need some kind of catalyst in order to have that unwind. To your point, though, on forward returns, I think it's really important because what we find is things like valuation and positioning, they may not have a very good 1 year predictive power on forward returns, but once you go out 5 to 10 years, their predictive power goes up significantly. And this builds on the work of probably my favorite strategist on the street, not just because he was an industrials cyclical analyst, which I spent a good part of my career covering industrials, but Barry Bannister over at Stifel. He publishes this forward view of equity market returns using valuations and positioning. So he uses Tobin's Q, which is the replacement valuation of capital. He uses the KPE ratio, that cyclically adjusted P ratio, really long moving. And he uses the percentage allocation to stocks by households. And what he finds is that when all of those things are elevated, 10-year forward returns in equity markets are kind of abysmal. The challenge is that there's a lot of different ways you can get to low forward returns. You could have a massive rally up and then a huge crash down. You could have a sideways market, or you could have a crash and then a rally, and all of those would actually create the same kind of average returns. So that's when you say, okay, I know what my long-term might be, which is less than stellar returns based on these metrics. But I also know that I have to be appreciative of the shorter term trends, respect the trend, respect the technicals, and then use those shorter term metrics to help inform how the path we might take to get to those lower forward returns.
And does long term versus short term by definition mean different things in different asset classes? I'm thinking about international stocks, for instance. Was that the case with international stocks? I think you recently wrote also that international stocks, you can't just look at the valuations and say, hey, they're super low relative to U.S. markets. That's a time to buy. There's other factors.
Yeah, I mean, they've been value traps for the last 7 years. They started 15 years ago, coming out of the Great Financial Crisis and going into the Great Financial Crisis, having had a massive bull market in non-U.S. stocks. There was an emerging markets bubble. And just like every bubble, it doesn't end well. And how it hasn't ended well has been 15 years of relative underperformance of EM and international developed stocks versus the US. And by the time you got to about 7-8 years ago, you got to the point where you could argue that these stocks were cheap. And so you had a lot of people at the beginning of every year, people come out and be like, now's their time to shine. And the challenge is that we think that there's two conditions that you need in order to see a sustained bull market in non-US stocks. It has to be a major dollar bear market, meaning that you have to have a period like 2000 to 2007, or a period like 1985 to 1989, where you see a major downturn in the US dollar. That sets up for bull markets in non-US stocks. The other one is earnings, and they're interrelated, meaning that you have to see an inflection in the earnings growth. The most surprising thing to note is that you've seen US earnings from 2007 to today increase by about 150% from that peak to peak. If you go and compare that to emerging markets or international, emerging markets are still down versus their 2007 peak, and international is up only a couple percentage points. So valuations are not a timing tool, and they can be a trap, and things can be cheap for a reason. Eventually, this will turn, and it'll be a really, really big tectonic shift in markets. But until you can make an earnings story, and until you can make a dollar call, we think that they will continue to languish.
What factors do you see playing into a turn in the dollar, for instance?
A lot of the dollar is, of course, dependent on big things like comparative monetary policy. So if the Fed were to be perceived as being much weaker than other central banks, that has typically resulted in a much weaker dollar. It also is dependent on capital flows. So this is a bit of a chicken and an egg scenario. One of the reasons why the dollar was so weak over the course of the 2000s is because you had the bursting of the U.S. internet bubble. As capital was flowing out of the U.S., as people said, this is uninvestable, was flowing into EM and international, that amplified the U.S. dollar movements lower. So you have to think about that. That's an aspect of positioning as well. So you've had, of course, we see it with the yen with short positioning, but there's also, for example, a massive short position within the Canadian dollar. So you have to consider that sometimes the fundamentals might tell a very clear story about what something can do, and it doesn't necessarily turn out that way simply because of positioning. One last thing is that a lot of people will try to use things like twin deficits for a dollar call. And that led to, and I'm going to get the year wrong on this, I think it was to 2021 or 2022. So we can fact check me later on. But there was this big call, I believe it's the start of 21, where everybody said, oh, huge deficit spending, huge trade deficits, we're going to have a weaker dollar. But dollar positioning was already super short, and we ended up having a massively strong dollar in whatever year I'm referring to. It's just an important point that that positioning matters oftentimes a lot more than the narratives we tell ourselves. And sometimes things are drivers, but they're just drivers over long term, where positioning can be kind of more shorter term.
So you can tell, I'll probably borrow you from your Left Behind summer series of articles. And since I'm on that, let me ask you about growth and value. Value, too, has kind of been a laggard for a long time. If earnings are slowing, is it time for value stocks?
It so depends on earnings. One of the reasons why value has underperformed growth so much is because value earnings have been revised lower and growth earnings have been revised higher. And what we see is that when you are revising earnings higher, you typically see multiple expansion. When you're revising earnings lower, you typically see multiple compression, because it really captures risk on, risk off, growth appetite, et cetera. So we think that in order to see a sustained turn in growth versus value, more than just a positioning snapback, that you need to see value earnings revisions and flex. So that's an important one, because it's not just the level of earnings, it's the direction that they're going. So one of the dynamics we've seen this year is that value was supposed to have earnings that kept in line with growth going into 2024, but they've been revised lower. It was a bar too high. And if you look at 2025 earnings, the market has a big, huge reacceleration in value, a kind of sustained pace of growth within growth earnings. And so one of the questions we're asking ourselves is, are we set up for failure again, set up for earnings revisions lower, simply because you have a higher bar to jump over? One last point is that we saw growth versus value go parabolic in June and July, starting in late May, June into mid-July. The ratio growth versus value went straight up. And Walter Deemer, who is one of the greatest technical analysts of all time, he says, when things go up in a straight line, they don't correct by going sideways, they correct by going down in a straight line. So the last couple of weeks within August, what we've seen, of course, is that growth versus value has corrected sharply. It's now sitting right at its, I believe, 200-day moving average. I was looking at the chart earlier today. It's either 50 or 200. Don't quote me. But the point is, it's sitting right at support. And I think it remains to be seen if it corrects through support. It really does depend on the earnings trajectory. The last part is that growth is expensive and crowded. Value is cheaper, not cheap, but cheaper and underowned. So if you do get that earnings story that materializes, and remember, value earnings outperformed growth earnings in 2022, hence the value rally, that you would be set up for a big leadership rotation change. If not, then you get these short bursts of recalibration. And, again, it brings you back to balancing the fundamentals with the technicals.
In your outlook, I think you guys put it out mid-July or so, you'd written about the Republicans running away with the election, but that was before Biden dropped out. Has anything changed with Kamala in the race now and in terms of your outlook?
Well, you've certainly seen the odds of the Trump presidency and a Republican sweep drop dramatically. And now, we're in a much tighter race versus having it look like a shoe-in. And in a way, markets have liked that, we think. It's hard to isolate because obviously there's a lot of other things going on, but there was some consternation within fixed income markets in thinking about a sweep in either direction. This idea that, austerity or deficit reduction isn't something that either party is discussing. And we know the experience of what happened in the third quarter of 2023, where Treasury increased coupon issuance, and you saw over 100 basis point increase in the 10-year Treasury in just a few months. That if you were to see higher deficit spending because of a sweep within Congress, then maybe the bond market begins to balk at these big Treasury issuances. It's something that's on everybody's mind of whether or not the deficit is a clear and present danger. And what we've seen is that certainly we are in new territory of the level of deficits that we are running, not being in a recession, not being in the midst of an active war that we are directly involved in. And so, of course, there is concern that if you were to see this continue, do we start to have more Treasury market kind of kickback against these higher deficits? It's certainly possible, but it's one of those things that people have been talking about it and fearful of it for decades, and it hasn't been a key driver of financial market returns. So we think it's best to continue to monitor it closely, continue to monitor the bond market mood closely. I think the Treasury and the Fed got smart about coupon issuance. And if they hadn't gotten smart, maybe we would be having a much more pronounced conversation. But what Yellen has done with things like bill issuance has certainly taken the pressure off of that. So all in to say, very dynamic situation, and one where it's a risk that we see is out there, but not necessarily one that you want to position for today.
How are you all positioned in fixed income markets today in terms of greatest possibility of good to your portfolio?
Yeah. So we just did something that on the surface looks silly, but I think in practice there's some logic to it, where we closed out a big underweight that we had in small caps for a long time. And actually, so we went to neutral and then went underweight high yield. And the thought process is that they're rather correlated assets, but the risk of a runaway to the upside within small caps was much higher than that risk within high yield, but that they had similar downside. So if you looked at your risk reward, you actually had better risk reward within small cap versus a high yield for like the same kind of unit of risk. And so what we decided within high yield is that we want to progressively move, and this is something we do even in equity portfolios, is the progressively moving higher and higher up the quality spectrum, and that we didn't think that we were getting well compensated for taking on high yield risk. Appreciating the high yield index is very different than it used to be. There's a lot better companies that are in it. It's not nearly as junky as it used to be. But if you look at the triple B to double B spread, it was tighter than it was in 2021. So what we said is that, you're not really you're not really getting that much for the incremental risk. So instead saying, okay, let's move up a little bit into investment grade, you go into an underweight position within high yield, you can still pick up credit within the investment grade index, but be selective in doing it, that you should have less potential downside if you were to see a moment of economic weakness. We did think at the beginning, one of the things we put out a piece on Monday for clients in the midst of the August 5th meltdown that day in the morning, and said, hey, yields are really oversold. Bonds are overbought. Be patient, putting capital to work within fixed income and extending duration, that you're going to get likely higher yields in the coming days. They just moved too fast to the downside. So that's also something that as we see yields bounce higher, we'd likely be buyers of longer duration exposure, simply because we do think that yields overall have been making this topping pattern that would suggest that you're moving lower, but in the pathway to get there, you could certainly see it bounce higher in yields.
Do you see yields higher in the longer term, I don't know, 2 or 3 years from now?
It's something that we debate a lot because we're a couple weeks away from the Jackson Hole meeting, and the Jackson Hole meeting, the topic of it is the effectiveness of monetary policy. In this brave new world. Not the exact title, but that's what they're getting at, and that implies a discussion about the neutral rate, which is that if you're asking about how higher rates the economy can handle and how much the monetary policy has slowed or accelerated growth within the economy, then what you're talking about is what is that long run neutral rate? And if it is in fact higher, meaning the economy can grow with rates being higher than they were, in the secular stagnation period post the GFC, then that would suggest that maybe there is upside to longer term yields. You add on top of that the fiscal question and funding of deficits, and if you see this movement higher in long yields, you also have to just balance it, which is that you have to consider that in times of duress, you also see a flight to safety. So our head of portfolio strategy, Brian Nick, quipped earlier in the week, he goes, I don't think yields are dropping because they solved the deficit. Effectively saying, there's not just one thing that moves long-term yields. And if you see the flight to safety, that certainly is something that can move them in the opposite direction. So lots of cross currents.
Yeah, absolutely. Are there areas right now that you find particularly attractive that you might go hunting in?
Within the equity market?
Equity, fixed income, just something that is particularly appealing to you.
Yeah, so we're always finding opportunity within, if we think about the equity markets, we launched a small and mid-cap strategy earlier this year focused on quality and identifying that you had a lot of really strong names that were trading at significant discounts to larger cap peers, and we did small mid-cap, so you don't immediately ding yourself when companies grow out of the small cap universe. So that was something that we certainly had conviction on. We also saw opportunity. We've seen opportunity over the course of this year within the municipal space. So for clients sitting on big cash balances, we've been biting into getting when yields are moving higher, allocating more into municipal bonds, getting cash, that reinvestment risk reduced, and getting people into closer to longer term allocations. Outside of just equities and fixed income, though, we're also seeing opportunities within the alternative space, highly selective. So, for example, we think that you can do that there's opportunities within things like private equity, but you can't just do what worked in the last cycle, which was a lot of growth equity and large cap buyout. That doesn't really work in the yield environment where we are. So instead, we're focusing on lower middle market. We're focusing on GP stakes. We're focusing on secondaries, areas where we think that that can still thrive in this environment. We also are doing a lot of work on infrastructure right now. We think that in a world where equity returns were just so stellar that people kind of forgot about infrastructure. But if you want something that's less correlated, but still can deliver, high single digit type of returns, we think that infrastructure is an area where people are probably under allocated, and that it can be a really great ballast within a portfolio, mostly if we go into that lower return environment. So, it's finding, we love to find areas where we see, we call it, the whooshing sound as everybody's leaving the door and kind of steer into disruption. But when you do that, you have to be highly selective and back it up with a lot of due diligence, which is, a rather industrious process.
How do you determine to allocate to a theme? And it seems like so many thematic, say, ETFs that have come out in the recent years, they're all some different flavor of tech. Not all, but a lot of them are. And I don't know, how do you look at that? And how do you have separate thematic portfolios that you run for clients that are just themes, or do you sprinkle in a little bit of cybersecurity with a little bit of robotics and take out the QQQs, whatever? I don't know. Just high level.
This is where my own bias, I think, starts to show a little bit. And I can be convinced otherwise. But I used to cover industrial stocks. And industrials are the catch-all for the S&P 500. So if it doesn't fit somewhere, it fits in industrials. So it's a hodgepodge, which also means that it can effectively be any theme you want it to be. And there is a company that probably has exposure to it. So I was always bombarded with, give me exposure to this theme. And what I found is the way that a lot of investors did it was way too crude. They would look at the source of the revenues and say, 10% of the revenue growth from X, Y, and Z company comes from this theme. Let's buy it for this basket of stocks. Not realizing that that portion of the business doesn't generate any operating profit, or that there are other bigger things going on. And so the other aspect of it is that people would get gung-ho on a theme and think that they're doing great and they're getting exposure to this long-term theme, not realizing that they're just buying a cyclical stock. My favorite example of this is robotics. So the different robotics ETFs, if you look at them on a relative performance basis, what you find is that they're very, very correlated to the PMI. And so you're going to pay a premium to get PMI-like exposure. And one of the things I remember, we were having this big, huge robotics rally, I think in 2017, and everybody's like, everybody's going to lose their jobs and robots will rule the world. And, people were buying into it into this robotics ETF. And I was screaming out at guys, the PMI is currently at like 58 or 59. You don't buy cyclical stocks when the PMI is that high. It's just, you don't do it. It can't get any better. Second derivatives are not your friend there. And it's just a great lesson that just because there's a narrative doesn't mean that it's a great stock. So it gets us back to, it's like, we do identify these themes, but of what we think are going to be strong drivers of earnings, but it has to match with valuation discipline. Does it mean that we sit out on certain rallies? Yeah, but we also sit out on the collapse on the other side. And that's what we also tend to see is very episodic upside, volatility, and then a big reversal to the downside. Look at the stay-at-home stocks from 2020. Amazing theme. And then it imploded. So I think that discipline, that valuation discipline, as well as knowing where you are in a cycle, even the most secular story has cyclical impacts.
Yeah, absolutely.
Good reminder for semiconductors.
That's true. That's a hot one right now, and AI-related portfolios as well. I wonder if I could ask you a little bit about your background. I think you have a pretty fascinating background from what I can tell, and how you got into the business. Maybe I'll just leave it open-ended like that, let you kind of run with it.
Yeah, I will. It starts with the point of, I think I have the coolest job in the universe. The fact that I get to sit and have a conversation with you and it's work is amazing. And that every day it is diving into new topics, getting up to speed on things that I originally didn't know anything about, and getting deep knowledge about things at the same time as making sense of the world, synthesizing information. And the origin of how I even found myself in the finance industry is one where, I quit high school to be able to dance ballet full time. I got injured, ended up saying, okay, I guess I'll go to school, if I have to. Found my way into economics. I fell in love with economics because it was like taking a little piece of every part of a liberal arts education. So you have your history, your sociology, your anthropology, in some ways, your mathematics, your psychology. They all fit into this world of economics. And then I found myself in business school and thinking, getting a business degree, and I have a background in the arts, let's do marketing. And I was bored. And so I said, what's the hardest class I could take? And somebody said security analysis and portfolio management. And I sat in the first class. The guy was speaking, Greek, had no idea what he was saying. And I think I cried in his office for the first 2 weeks. Like, I don't understand anything. But I instantly fell in love and found it so fascinating because finance in many ways is just applied economics. I desperately wanted to work in finance and get to work in New York. And that came from, I met with tons of I come from Florida originally. So, I wanted to go the other direction. And it was very fortunate that, and this is the coolest thing ever, my professor, Clay Singleton, Dr. Singleton had I
know Clay Singleton, right? He was at Ibbotson Associates at one point, right?
Yeah. Oh, no way. What a small world.
I worked there, yeah.
That's so cool. So Dr. Singleton, you created a postgraduate scholarship in honor of Dr. Edward Moses, who was the dean of Crummer Business School. And I got a scholarship at the end of my business degree to sustain me to find a job. And so I got money at the end of school so that I didn't have to take the first job. And that allowed me to apply for the CFA program. I applied for a scholarship to cover part of the exams. The guy who was adjudicating the scholarship was a PM at Bank of America. Said, come in for an interview. I had no work experience, and they gave me a courtesy interview, and I was very fortunate that they believed in me, and I got the job. And so that just catalyzed, eventually, kind of moving up to New York. And so when they say it takes a village, it really does. There's so many different people in my career and background that there's no way I would be where I am if it hadn't been for their early belief and me. Sometimes I would argue incredibly unfounded, but I hope to continue to honor them with the work that I'm doing.
Well, that's fantastic. I was going to ask you if you had a mentor or someone you really looked up to in the industry, but it sounds like you have a team of people.
Yeah, it's absolutely a team. I had, incredible bosses at Bank of America who were so good. I had the opportunity to work under Chris Heisey, who was our CIO at Bank of America, and for a man by the name of Brian Daly, who ran our equity team. And the two of them set such a high standard of excellence in the kind of analysis as well as the presentation. And Chris, his background of becoming CIO in the midst of the great financial crisis and holding people's hands and keeping them calm and getting them invested and communicating in really sharp ways. I've said if I could be 5% of a CIO that he is, then I'm moving in the right direction. But it's always, you look back and all these different turning points wouldn't have happened if it hadn't been people kind of going out of their way to be supportive.
All right. As we start to close out, I usually ask guests a couple different questions. The first being, what's one long-term trend you see playing out over the next year or several years? And it can be about anything, asset classes, anything we talked about, or something else just top of mind.
I think that we have this longer-term trend of automation that has been in place. And my take on it would be that there are certain pockets of it that are truly revolutionary. And I am no expert on this. So folks that are experts that live much more closely to this will probably disagree in some ways, but that you see these big step changes in functionality in certain pockets of AI that have been absolutely revolutionary over the last couple of years. But there's other pockets of it that have been much more evolutionary. And I think one of the things that we're going to be doing over the next couple of years is determining in a much more fine way of the areas that are just evolutionary versus revolutionary. And that, I was close to a lot of these industrial companies that have been using what we used to call big data. Now it's AI, but big data type of analysis in order to do things like predictive maintenance and designing different machines better. And that's been a process that's been ongoing for quite some time. So I think the interesting thing that will happen over the next year is that the AI theme will stay around, but it's going to become far more nuanced versus, that blanket statement of like, this is as big as the internet and it's going to change everything. I've been in the camp that it will change a lot of things, but it's going to take time, and it's going to be one of those things that will maybe be less of a blanket and more more focused.
Fantastic. And the last way I finish off is playing around a trend or fad. You up for that? I'll ask you about 3 or 5 different topics and get your quick take.
Sure.
Bitcoin, trend or fad?
Neither. I think narrative is very different than price, but I think that if you want to isolate certain factors, saying being bullish on liquidity, being bullish on fears about debasement of the dollar, that it's a really good vehicle to do that. But I'm not in the camp that, we're in a new monetary order.
Buffer ETFs, trend or fad?
I think that they've been untested. We haven't been big users of them. So I don't want to speak too much about something that I'm not as familiar with.
Fair enough. Good disclaimer. EVs, trend or fad?
I think that it's one of those where it's in between. There's certain applications, but the hybrid approach seems to make a lot more reasonable sense. For certain people, it makes a lot of sense with their driving behavior. Not something we lose a lot of sleep over. and not something that we have been, big investors in.
And just kind of a fun, stupid one here. Cottage cheese queso. Have you had that?
I'm not a cottage cheese person. If you want to give me a soft cheese, A, if I'm eating cheese, I don't want it to be healthy. B,
right, good.
The best cheese in the universe is stracciatella. It is the inside of burrata, and it is mozzarella cheese that's pulled through cream. And it is the most delicious, amazing cheese ever. So don't give me your like healthy stuff. Absolutely not. If I want to be healthy, I will eat a carrot. If I want cheese, I'm having stracciatella.
Fantastic. And as we wrap up, it's noon here on the East Coast, so that's a perfect time for lunch. And, I got to ask you we'll just do it anyway because you're a music fan. What's on your playlist?
So I'm listening to a lot of Pearl Jam as I'm getting ready to go see Pearl Jam in September, which is very exciting. If I'm pulling it up, I was clearly listening to Smashing Pumpkins this morning. And then, and I hate to admit this, but this just is what it is. As a kid growing, as a brooding teenager who grew up in Florida, old emo mix is up there. So there it goes. There's some great old stuff. But I'm also going to see Incubus with Coheed and Cambria. If people are into sci-fi and they like metal, Coheed and Cambria is one of the greatest bands ever. So
I got to look that up. That's awesome.
Yeah.
Well, Cameron, thank you so much for your time and all your insights. Appreciate it.
Thank you so much for having me.
And actually, what's the best way for people to learn more about you and New Edge and stay up to date with what you guys are doing?
I'm on X at Cameron Dawson and on LinkedIn as well, where I do a lot of posts. You can also go to newedgewealth.com, where our weekly piece is published, and you can sign up for the distribution list as well and read all of the past archives.
Fantastic. Again, thank you very much. And thank you for tuning in to another episode of Trends with Benefits.